Public blockchains operate on radical transparency, broadcasting every transaction to the open network. But when that open data model collides with the strict privacy mandates of traditional finance, the systems shatter. Digital asset markets run globally 24 hours a day. They allow for instant liquidity settlement across borders without waiting for intermediary clearinghouses or banking hours. Traditional institutions operate under rigid legal frameworks. The Bank Secrecy Act requires strict anti-money laundering measures. Know Your Customer regulations demand identity verification, and GDPR strictly prohibits storing personal data on an immutable public ledger. This creates an architectural deadlock. Financial institutions are forced to choose between using efficient open ledgers and violating data protection laws. The legacy financial system relies on centralizing risk. Banks build honeypots of customer data, and they attempt to prove they hold your assets through opaque accounting audits that only capture a single point in time. The vulnerability of this system was exposed when FTX collapsed in 2022. Billions of dollars in customer deposits were mismanaged and commingled, causing an industry-wide shock and wiping out trust in centralized custodians. Zero-knowledge proofs, or ZKPs, offer a strict mathematical alternative. A ZKP is a cryptographic protocol where one party can prove to another that a specific statement is true, without revealing any of the underlying data. Instead of reactive after-the-fact audits, ZKPs allow institutions to embed regulatory rules directly into the protocol. Compliance becomes an automated mathematical guarantee. At the individual user level, identity verification starts with self-sovereign identity, or SSI. SSI is a system where trusted issuers, like a government, send digital verifiable credentials directly to a user's private digital wallet, rather than storing them in a centralized database. In a traditional verification process, users must hand over copies of their physical passports to a third party. That third party stores the documents on their own servers, creating a high-value target for data breaches. ZKPs enable a process called selective disclosure. A cryptographic circuit verifies a specific claim, like age or citizenship, without exposing the raw data contained in the verifiable credential. To meet the European Union's upcoming eIDAS electronic identification regulations, tech companies like Google are integrating zero-knowledge proof libraries into their digital wallets. In a recent partnership with German Sparkasse banks, the wallet generates a mathematical proof that the user's birth date is strictly greater than 18 years ago. The bank receives the proof, but never sees the actual date of birth. Identity verification no longer requires hoarding toxic personal data. Institutions receive absolute certainty about their customers while eliminating the liability of storing sensitive information. For multi-billion-dollar institutions, the challenge scales up. A digital asset exchange needs to prove it holds enough reserves to cover all customer deposits without publishing its entire confidential customer ledger. They achieve this using a cryptographic commitment structure called a Merkle tree. A Merkle tree is a data structure that securely aggregates large sets of information by repeatedly hashing pairs of data together. Customer balances are converted into leaf nodes, like James 75. These are mathematically combined through bottom-up hashing to produce a single state root. Alice traces her balance of 32 up through the hashes linking to the state root to verify her funds. Cryptographic hashing is a one-way mathematical function. It is mathematically impossible for Alice to reverse engineer the hashes along her path to extract the balances belonging to Jane, or Amy. This structure allows an exchange to publicly commit to the total sum of its liabilities. It proves the debts exist while maintaining perfect, impenetrable privacy for every individual account holder. A basic Merkle tree audit has a critical vulnerability. It assumes all numbers inputted at the bottom are legitimate. A malicious exchange could execute a negative balance attack. By injecting a fake user profile with a massive negative balance into the tree, they could artificially erase their total debt and appear fully solvent to regulators. The solution to this vulnerability relies on a specific zero-knowledge proof called a range proof, utilizing inner product arguments like bullet proofs. The exchange must prove every hidden balance is strictly positive before entering the tree. The abstract balance is broken into a binary vector, multiplied against a strict boundary limit. This verifies the number is positive, producing a verified output without displaying the base integer. This mathematical guarantee ensures that no negative liabilities can enter the system. The fraud vector is entirely neutralized. Range proofs enforce perfect accounting physics inside the digital ledger. They make it impossible for an exchange to lie with math. Placing a cryptographic proof of assets next to a secured proof of liabilities Merkle tree creates a zero-knowledge proof of reserves. The final logical gate of the protocol proves that the total assets are greater than or equal to the total liabilities. This generates a single, succinct ZK Stark proof. A ZK Stark is a type of zero-knowledge proof that uses scalable hashing functions, making it highly efficient for verifying large datasets. Following the collapses of 2022, major exchanges like Binance and OKX deployed these exact architectures to prove their multi-billion-dollar asset backing to the public. Traditional external accounting firms produce slow, point-in-time reviews that are out of date the moment they are printed. A cryptographic proof of reserves provides a continuous, real-time guarantee. The financial market is moving away from a standard based on institutional trust and toward a standard of continuous, user-verifiable cryptographic proof. The core operational philosophy of zero-knowledge proofs comes down to 4 words: execute once, verify everywhere. The system creates a massive computational asymmetry. The institution, acting as the prover, does the heavy lifting of hashing millions of accounts and running range proofs just once. The resulting mathematical proof is incredibly small and lightweight. Anyone in the world can act as a verifier and check its absolute truth in milliseconds using a standard computer. Financial institutions no longer have to choose between the high-speed efficiency of public networks and the private regulatory compliance required by law. They can execute both simultaneously. Zero-knowledge proofs do not act as a temporary privacy patch. They provide the strict infrastructure upgrade required to run global, trustless finance.